Hey everyone, Brian Bogner and Greg Towner here, and it is time for the 20-minute market breakdown for the month of April. So, Greg, how are things going with you?
Hey Brian, I'm doing great. I'm just I think like most people these days enjoying spring, getting out there and doing some walking, doing some biking, enjoying the good weather, fighting off the humidity as long as we can, right?
Yeah, weather has definitely been fantastic, no doubt. Kind of warmed up a little earlier, I think, here in the southeast than normal. But hey, at least we're in the upper 70s, lower 80s most days. Gets chilly at night, not a lot of humidity, so get
Yeah.
outside, get in the sun, doing a lot of fun stuff out there. So that has certainly been great. So while weather has been good, right? um the markets, on the other hand, have been quite interesting, haven't they?
Oh yeah.
We continue to deal with just a lot of emotions right now in terms of what we're seeing and talking as we talk to folks and things like that. And if you think about it, it's really not just recent. I mean, if you look back over the last couple of years, we've seen some massive extremes of emotional investing, right? Of course, I always reference back to the COVID time when the world had literally stopped, and what happened then. We went through an election. We went through right now, we're in a so-called banking crisis, right? That a lot of
Right.
people are concerned, oh, the bank's going to fail. And there's just a lot of emotional investing. And I think what is causing a lot of this is the fact that there's just so much more media outlets and things like that people have touch bases with. I mean, back in the day, remember? I mean, remember you and I sitting there in our, trading floor, and we had CNBC on the TV, and that was it. Like, what was ever coming out that tube was all you were going to get when it came to the markets. That was it. There was nothing
Right.
else. Now,
Yeah.
I mean, you've got every little nook and cranny and things like that popping stuff to you all the time. And I think what that's done is it just amps up our emotions, right? And we're just like I feel like we're on the edge all the time. Like, oh my God, this might happen, that might happen. What about this? What about that? What about this? What about that? So we're dealing with these extremes of emotional investing. What do we do about it?
Yeah, absolutely. And before we get into what to do about it and where we stand today, I do think it's important to kind of look back over the last couple of years to remind people of just how much that the emotions have ridden this roller coaster, to
Sure.
remind them, that maybe they'll remember, oh yeah, you know what, I did, that did affect me, that sort of thing. So
Right.
we're not going all the way back in history. We easily could, but let's just go back, a couple of years. 2021, that was, a year plus into the pandemic, markets were surging, but not just the markets in general, but specific areas were incredibly hot, and it was really attracting people, really getting excited about all the growth areas, and of course crypto, and all
Mm-hmm.
these startup companies that with no earnings, and all the meme stocks as they became known. I mean, there was some things that were crazy. What was it? AMC, the movie theater, went from like $2 to $72. Of course, now it's back down to 5. There are other examples as well. Everybody was just really, frankly, getting greedy. They
Yeah.
were getting super excited about
Yeah.
things. But we of course know, the roller coaster doesn't only go up, right? So the next year, last year, 22, things came down pretty hard, particularly some of those areas that had gotten so bubbly. And so a lot of that, extreme positive sentiment went away. It went away quickly. People kind of started to get discouraged, distraught over some things. Some of those high growth areas were down 70, 80, 90%. And that brought us to the fall of 2022. And what happened then was a low in sentiment. Everybody was really negative. There was a survey done of economists. 100% of them thought we were about to go into a recession. Inflation was at its high. But what happened at that really negative point? Stocks bottomed. Right now, of course, we'll only know down the road if that was the ultimate bottom. But for the last 7 months, stocks have been rallying
Mm.
because everything kind of bottomed at that point with
Mm-hmm.
negativity, again, that roller coaster of emotions. Some other areas that we've been talking about, international stocks, right? It hasn't done well in forever, right, Brian? I mean, 10 plus years, international's done poorly. So, of course, no one wanted to own them.
Right.
and they still don't want to. But a lot of those people probably don't realize, 6, 9, 12 months now,
Right.
they've been outperforming. A lot of
Right.
international has been strong. And if we go back over time, they tend to be a good portfolio diversifier. But people don't want to own them because they've done poorly recently. The memory of that. Last year we had bonds had their first bad year in a long
Right.
time. So people are like, "Oh my gosh, I didn't realize bonds could do that. I don't want to own any of those." It's just kind of the recency bias. Yeah, and so that kind of brings us to today. What are people thinking today? And we have a really few good, interesting surveys that we came across, and one was from JP Morgan. They said 95% of investors that they surveyed expect the market to be lower by the end of this year. 95%.
Hmm.
Bank of America did a survey of mutual fund managers. They were the least amount of them were overweight stocks since 2009, March 2009. As a reminder, that was the low for stocks when they
Right.
didn't want to own
Right.
any. And then a CNBC survey found that 69% of the public had negative views about the economy both now and in the future. That's the highest in their 17-year history. So it's interesting that normally you'd see this kind of extreme negativity when stocks have been really beaten up and at a low, but we've actually been rallying for 6, 7 months now. So it's a really interesting period of negativity we're seeing.
Yeah. Yeah. Without a doubt. You have this swing, right? Of like you mentioned in 21, like even I was talking about earlier about, the media and all these things. We had meme stocks. We had stocks that were rallying just on social media postings and all kinds of
Yeah.
stuff like that, right? Then we had this last year, and now, even though the market's been rallying this year, right? People are negative on what's going on, right? So what does all this mean?
Yeah, I mean, it's more evidence that people, tend to either chase returns, what was hot recently, or, run away from what didn't do well recently, kind of
Mhm.
groupthink, they
Mhm.
all kind of group themselves together, both the professionals and individual investors. And it's just more evidence to us of what we already knew, that emotions
Right.
drive so many investment decisions, unfortunately. But, I mean, we think sentiment is a critical part of an investment process, but it
Mhm.
doesn't, guarantee things.
Right.
I mean, there's only one tool that we, access in our process. But when it does get to extremes, it does kind of open our eyes. And we think that, people should at least be aware of what their emotions are, what the broader, emotional perspectives are of investors at any time, because it can really kind of push things in one way or another if other catalysts come on board.
Right. So we know that there's been some emotional extremes, and you gave some great examples. We also know that, you know, that look, emotions do drive investment decisions, unfortunately, and we are kind of at some extremes here, sentiment wise. So what do we do about it, right? I think there's a few things to consider. One is, to really take this is probably a good time to look at your asset allocation, right? And just make sure it's not based on market conditions. Meaning, for the last 10 years, if all you owned was large cap growth stocks, guess what? You did great. But that doesn't mean that, over the next 10 years, that's where you need to be. Being diversified means there's always an asset class in your portfolio that's underperforming, or you're missing out. Maybe, that's the whole point. You're never at the extremes, but you're in this nice lower volatile area that over time should continue to grow. And so this is a good time to reevaluate your asset allocation. Give us a call. We'll be happy to sit down and go over that with you as well. It's also, in doing that are you underexposed maybe to international and fixed income? I would be willing to bet you possibly might be. I know here at our firm, we are looking to increase and have been increasing those areas with our clients. Ignore the noise. Again, what's causing a lot of these swings emotionally is the noise. It's this social media stuff, or I keep saying social media, but it's just the media, right? Media, traditional, non-traditional, and whatever. You avoid the noise, and like, it's funny. CNBC used to be the thing that Greg and I watched all the time early in our careers. We don't watch it at all anymore. We don't. We pay for very good research and pay for people that we have been following for the last 25 years. And we read their stuff because we know it's solid and it's good, but we don't watch anything on TV. We're not getting stuff on some whatever feed or things like that. You have to ignore the noise. And I would say, lastly, what to do about this is make sure you've got a disciplined process. We use the QRLT process here in our investments, and it works in good times, bad times. All you want to make sure it works in all avenues as well. So make sure you've got a good process, and that'll get you through it. I mean, if there's one theme that we keep talking about on this call, it's like figuring out how to pull those emotions out and able very objectively to look at what you're doing and how you're doing it. If and I'll be honest with you, there's a lot of people that just can't do that on their own. That's where we come in. We come in to help, right? We've got a process to help do those things. So with that being said, I think I feel like we're a lot less than 20 minutes today, Greg. I think we've kind of moved through this. I forgot to start my timer here, so I don't know how far we are, but our
That's
goal
all
is
right.
always
People don't mind it being shorter, right?
yeah, our goal is always keep this 20 minutes or less. So you're probably going to be blessed this month with a episode here less here. So Greg, let's go ahead and close this out. What do you got? What do you got for us?
Yeah, I've got a couple recommendations for everybody. I mentioned right off the bat that enjoying spring weather. Well, I've got a couple new toys that I've been enjoying, and I know back in the day, Brian, we did a lot of bicycle riding together. So I mentioned toys. You're probably going to ask me, "Oh, did you get a new mountain bike or something?" No, Brian, we're middle aged now. My new toys are a battery powered yard equipment.
Oh,
you know,
really?
yeah.
What's
So
what specifically? Like, what's your favorite thing?
well, so the brand is I went with steel, the steel brand, some really good quality. I got these really long extended hedge trimmers. We have some
Nice.
shrubs that are hard to reach, so the really long pole. And then the same battery works for both that as well as the smaller lightweight leaf blower. I don't use it for like the whole yard. I don't mind
Right,
raking.
right,
It's
right.
good little exercise, but just kind of cleaning up, sidewalks or areas with stones,
Yeah.
that sort of thing. So I'm enjoying the new toys that I have. I'm sure the novelty will wear off at some point and it'll feel like chores again. But for the moment, I'm enjoying them. And I think if people are still using the noisy, loud ones with gas or hauling around a cord, I'd highly recommend upgrading to the modern, battery powered ones. So
And plus, there is something. Let's be honest. There is something therapeutic about like a project like that, whether you're trimming a hedge or doing something, and there's chaos, and then you bring nice cleanly order. There is something therapeutic to that, isn't there?
absolutely, I have to say I
Well,
enjoy that too.
well, listen. Next time you trip down to Greenville, let's throw those in the car and bring them down. I've got some great therapeutic projects for you at my house.
Yeah, we'll see about that. But of course, I do have a recommendation on the investment side as well. This goes into the whole ignore the noise and all that. One thing I've seen over the years, and regardless of whether the investor does their own managing of money or whether they have an advisor like us that does it for them, I think they do a better job if they look at their account
Mm-hmm.
less often. If you're focusing on it all the time, looking at all the little ups and downs, you're bound to just allow, again, we're going to say it again, those emotions to
Right.
creep in. So I would say, if you look at your account very rarely, let the compounding do its thing. If you have us or another advisor, let your professionals do the work. Uh, get the stress out of your life. Don't focus on it all the time. Look at your account less often is a big recommendation.
That's good. Good one there. I've only got two quick things. One is, springtime usually means spring cleaning, and Jeannie and I we've made a commitment this spring to really simplify some stuff. I mean, if you were to go in our upstairs in our house right now, it looked like a war zone as we have just been pulling things out and just getting rid of stuff. We're selling some stuff online. We're donating. We're doing all kinds of stuff, but we have decided to really start simplifying. And I would encourage you. There's some great books on this. I just think, and I think this is a good time of the year to do it. But when you can just get rid of a lot of things and make things a lot simpler and just not, I mean, I think even just mentally and emotionally, when things are sitting in a closet, just piled in there, it does not have a positive effect. At least for us, it doesn't. So, And it's a project. Like, I think we went into this thinking we were going to knock it out in one weekend. It's probably going to be a month project before
Mhm.
we're where we want to be. So, and lastly, as we again, I just want to reiterate, as we're going through this kind of emotional roller coaster time. We talked about reevaluating asset allocation. We talked about the discipline process and things like that. Give us a call if you've got any questions, or you just want to talk through some things, specific to you, to your portfolio. By all means, that's what we're here for. Happy to talk through any of these issues and things with you. And again, as always, thanks so much for listening, and we will talk to you again next month. Bye now.